Hi, and welcome to episode 2 of Money, Markets, and New Age Investing. I'm your host, Craig Weldon. Today, I'm going to really hit it hard today because we have the Federal Open Market Committee, the Federal Reserve Central Bank of the U.S. meeting on Wednesday. It is now Monday the 12th, Wednesday the 14th. We get the central bank. We get a new interest rate decision. Likely they will hike rates again, probably by another 50 basis points. The current rate, the top end of the band, they have a target band, the Fed does, for their Fed funds rate, which is the key interest rate that is considered their policy rate. This is the liquidity interest rate. This is the interest rate based on which banks trade liquidity with one another. I used to be a Fed funds trader in New York City early on in my career, and it's really a fascinating, wild, wild west kind of environment that is directly impacted by the Fed's policy. This is the interest rate that they try and basically hold steady at some level, basis whether they want to restrict liquidity or whether they want to make liquidity easier to get. Is credit easier to get? Is money for the banks easier to get? If money for the banks is easier to get, they're more likely to lend it. This kind of thing. And when the economy is in trouble and you see a decline in final demand, the Fed will push liquidity into the system via the Fed funds market by either cutting interest rates or executing what we know now as QE, which is quantitative easing. What does that mean? It's a fancy term. It basically says the Fed will print a bunch of money, the Fed and the Treasury in cahoots, prints a bunch of new money, uses that money to buy bonds from the market, usually the banks, and infuse that cash into the system, withdrawing assets from the system, basically becoming the buyer of they are the biggest buyer, have been the biggest buyer of U.S. Treasury bonds, in the market. And what's interesting now is they're not buying bonds anymore. They're looking to sell bonds. We'll get to that as a point of order in a minute. But in terms of the decision coming ahead in 2 days, how this will impact markets, it will be key because the Fed has already lifted rates from basically 0 to 4% and rather quickly. And since July, when Fed Chairman Powell first floated the idea of maybe we might have to pause because all these interest rate hikes that we're enacting now, they have a lag effect. They don't really impact the economy till further down the road. Well, they just went Mandelbaum on steroids. If you remember the old Seinfeld gag, Mandelbaum, the old man who was the fitness trainer for Jerry, and how he was every time he wanted to take it up a notch, and prove how rough and tough and buffed up he was. This is the Mandelbaum syndrome, where we're taking it up a notch. Well, since July, the Fed has taken it up a notch. They have gone Mandelbaum on steroids, like I said, and in August, at the Jackson Hole Central Bank Symposium, Fed Chairman Powell was very hawkish in his commentaries. Hawkish meaning more rate hikes, tighter monetary policy, less liquidity, and would continue to do so until they saw signs of an erosion in the labor market, which I'll get to on the back end of this conversation because we have a lot of this macro stuff to go through because it's critical to what direction the market's going to go here. We have a lot of intentions in terms of the goals of this podcast. One of them is to help educate you on the macro side, but also to give you timely information you can use in your investment decisions. So in that case, today is going to be heavy on the macro, heavy on the monetary, meaning the Federal Reserve. And if we look at the expectations for Fed policy in the future, they've gone from 0 to 4%. The inflation data comes out tomorrow. So it's a 1-2, wham bam type of thing where we get the inflation data and then the Fed comes in and reacts to that inflation data the very next day. Well, we fully anticipate that the inflation data is going to show a slowing in the rate of change in inflation, albeit still very high at 7.3. That's the expected number on the headline Consumer Price Index year-over-year rate of inflation, 7.3. The issue here is the Fed is already at 4%. If we look at where the market is expecting the Fed to continue to go, we can see priced into the Fed funds futures market, which is a very active market, really gives us an idea of what the market thinks the Federal Reserve is going to do in the future. And right now, that market is saying the Federal Reserve will take rates higher by another 100 basis points. Will take the Fed funds rate to 5% by the middle of next year. And then that would be it. And in fact, the market is actually pricing in a reversal of some of that tightening, 25 to 50 basis points by the end of next year. And in fact, by the middle of 2024, the market is expecting that the Fed funds rate will be all the way back to 4%, which is where it is now. The dot plot, which is the Federal Reserve's own macro forecast that they put out every quarter, the last one being at their September meeting. Their macro projections includes their dot plot, which is basically each Fed member is represented by one dot. Each Fed member says where they think the federal funds rate will be this year, next year, and the year after. Each one of those votes as to what rate represents a dot on their little scatter plot, which shows each Fed member in each dot, in each position where every Fed member expects the Fed funds rate to be in the future. Bottom line, if you take all of that into consideration, the Fed is right in line with the market, or I should say the market's right in line with the Fed, expecting 5% to be the peak Fed funds rate next year. Now, not every Fed member is looking for 5%. There is at least one or two or three that hold out the chance that the peak in the Fed funds rate might be only 4.5. If that were the case, and they would raise rates 50 basis points on Wednesday, which I do not expect another 75 basis points, even though the market's kind of key for that. I think they're going to tone it down. I think they're going to bring us 50, and I think they're going to give us some clue that maybe at 4.5, that they might not have to go again, depending on what the economy does. Give themselves some leeway. Take their foot off the brake, so to speak, in terms of continuing to drain liquidity from the system, considering that the economy is already showing signs of rolling over. If you look at the yield curve in inversion and in an inverted state to the degree we haven't seen since the 1980s, implies a recession is coming. Every time we've had food at home inflation above 6%, it peaked at 13 recently, we have a recession. Every time that we see the dollar up by 20% or more over the course of 12 months, we have a recession. And when you have those three things together, it's 100% in the past we've had a recession. Now that doesn't mean it's been black 5 times, it can't come up red. It can. We can avoid a recession, but in my mind, there's just no way that's realistic. So in that case, the Fed is going to have to, at some point, kind of give us a clue that, hey, maybe we've done enough here to at least kind of arrest inflation. Frankly, inflation's going to fall anyway. So the Fed may be going too far already if inflation is going to come down. It's a question of how far and how fast does inflation come down. Now, why do I say inflation is likely to come down over the next few months? It's pretty simple. All right, the inflation rate is a year-over-year rate. We already know what the prices were a year ago. We already know where prices are now. The gasoline price last February was $2.78 a gallon. The current February price in the futures market, soon to become the spot price within 2 months, we're right up against February. The current February price is $2.05. That's a 73-cent decline from a year ago. That's a 26% year-over-year decline in the price of gasoline that's going to work into the CPI numbers come February. Come March, it's even more deep into the negative, and we see that in crude oil too. So we know that energy is going to provide us a very large year-over-year decline in the rate of inflation coming in the first quarter. Now, if you bring inflation down to, say, 6, maybe even 5, 4.5% on Fed funds is a pretty high rate relative to a 5 or 6% inflation rate versus what we just had, which was 3% Fed funds rate against a 9% inflation rate. So the Fed has kind of caught up to some degree, and whether or not they say something about that will be key. Chairman Powell's press conference after Wednesday's meeting will be the key to the markets if he gives us any clue that maybe the Fed could be on pause here, all right? But the fact of the matter is that this is a bigger picture than just the Fed. People here in the U.S. and a lot of my listeners are very U.S.-centric and, to the degree that you kind of have blinders on and don't see that this is global. The degree to which food inflation in particular is going to be sticky. The degree to which food inflation and food at home is even higher than eating out. You could say, I'm not going to say it's cheaper to eat out, but is not as more expensive to eat out as it is to eat at home now relative to a year ago. And that's kind of interesting, and that plays into the whole recession dynamic. But when we talk about this being global, I can tell you I do this every day for my institutional clients, and I look at every country, because to me, everything matters, especially in this day and age of globalized markets and globalized information and the speed and quickness with which information is processed and acted upon. And when we look at that, I look at places that are not even like third world, not even emerging markets. I'm talking, hardcore second derivative economies, meaning they're second derivative to Germany, for example, in Eastern Europe, Poland, the Czech Republic, Slovakia, Latvia, Lithuania. These countries provide intermediate materials to Germany, which then finishes them and exports them. It is a key part of the German export juggernaut. These countries are a key part of the entire European economy, especially as it runs through Germany, which is, of course, Europe's largest economy. In places like this, the Czech Republic, Poland, Hungary, you have 30% food price inflation. You have high double digits, 12, 14, 18% rates of inflation on a year-over-year basis in these countries. All right? And these countries, how many places do you have here where you see this food price inflation that is such a large percentage of CPI, which is such a large percentage of the cost of living in places where they can least afford to pay more for food? All right? Let's take the case of rice. Rice now is trading higher. Rice is at levels we've only seen in the past twice. During 2007, when crude oil was $150 a barrel, last time inflation was really strong, or during the pandemic. All right, so this is like the third highest level of rice prices that we've seen in 2 decades. Why is that important? Because 50% of the world's population relies on rice as the majority of their food supply, of their food intake, of their source of food. So if you have a big increase in the price of rice, that impacts a lot of places, particularly in Asia, that can't afford to pay more for food, let alone pay all what they're paying already for food. And to think that this doesn't go about crimping consumption on a discretionary basis, I think when you're looking at this on a global prospect, you're looking at what could be a global recession. Let's not forget, when we talk about, this whole thing around interest rates, we talk around central banks ending QE, all right, and going to QT, which is quantitative tightening, meaning, all right, now they are selling bonds back into the market and withdrawing that liquidity, all right, taking liquidity out of the market, making credit harder to come by, all right. We already see it in some of the senior loan officer surveys where they're saying they're a little less likely to loan money right now. You have to have a higher credit score to borrow money right now. One of the things we've seen throughout this entire pandemic period in the U.S. is, first of all, you had big handouts from the governments. You had a huge, big bubble in savings in the U.S. You got the annualized savings rate on a month-to-month basis at one point was over $6 trillion in savings. That number has dwindled now to below levels that we saw before the pandemic. You hear people on TV all the time talking about this big pool of consumer savings. Baloney. It's gone. It's been spent. It's totally dwindled. Not only that, people have gone on a borrowing binge. You have several months of the largest ever single month credit creations for consumers in the U.S. in history having taken place in 2022. All right. So you're talking about consumers at the lower half of the income scale having to pay more for everything, from shelter to food to gasoline to insurance to even public transportation and parking, childcare. Everything is costing more. And guess what? While prices will come down and you will have disinflation, you're not going to see most prices will never go back to where they were before the pandemic. So that's another thing to keep in mind. Prices can be down 70, 80% from their peak and still be, like shipping rates, 50% above where they were in 2019. From that perspective, inflation is not transitory, it's permanent. And when you look at income in the U.S., average income now has started to wane. Right? It's kind of a one-off on income, while inflation is going to be more steady, more sticky, more long-lasting. And in that case, it puts the consumer really behind an 8 ball, particularly at the lower end of the income scale, where they've spent their savings, they've borrowed out the max, and their income is not keeping pace with price inflation. This potential for the consumer to cocoon in the U.S. is very high. But again, it's global. And we talk about central banks pulling liquidity out of the market. A great case in point is in the U.K. where the UK said, okay, guess what? We need to go QT. We need to go quantitative tightening. We've put all this money in. We've bought all these bonds. We need to sell some of these bonds and take some of that liquidity out. The second they started doing that, the market revolted. Why? Because at the same time, the new government in the UK proposed, let's create a whole bunch of new money to help consumers pay for their electric bills. Now, not only does this enable and facilitate inflation, it exacerbates it, but the bond market said no more borrowing, no more QE. We can't take it. And in the case of QT into QE, it was a mess, and the bond market nearly blew up. You had a big rise in yields. You had a big rise in the cost to borrow money, even for governments. This is a major problem. When you have the Bank of Japan, the European Central Bank, the Bank of Canada, the Central Bank of Australia, the Bank of England, the U.S. Central Bank, all basically printing more and more money, all right, and essentially, the cost of borrowing that money, because you have to borrow it, ultimately, you print it, but you're borrowing it from the bond market, going up. This becomes a real problem. In the UK, for example, the increase in the interest cost on the public debt is now represents 12% of revenue for the government. And that's just the increase from a year ago. 12% of the government's tax take in the UK goes to paying just the increase in the cost to borrow money for the government when they have to borrow more than ever. That's certainly the case in the US, certainly the case in Europe, certainly the case in Japan. All these countries have these problems. Even places like Sweden, where they haven't been as aggressive in raising rates, where inflation hasn't been quite as high, still has problems. This is everywhere. It really is. When we circle this back to the US, of course, this is one of the things where it's like you got to keep pace with the rise in inflation in terms of your asset appreciation, and we're just not seeing that in the stock market right now. One of the reasons is the dollar appreciation, right? Because monetary conditions are tightening, because all of a sudden you can have a 4% interest rate in the U.S. and a 1.5% interest rate in Europe. It makes the dollar more attractive. So you get money flowing into dollar to pick up those 150 or 250 basis points of extra yield, which, when you're moving billions of dollars around, that's a big deal. Hundreds of millions of dollars, just for, 2 percentage points, that's a lot of money over a 3 or 6 month or 2 year period. So you see money movement has a lot to do with the differential in interest rates. And in that case, you've had a lot of money flow into the dollar because the Fed has been so aggressive. But the dollar rising also has an impact on the economy in terms of tightening monetary conditions. Now, what does that mean? Well, that means that the dollar goes up, something else is going down. And when something else is going down, what that means over the last 6 months, 29 foreign currencies have reached new all-time or multi-decade lows against the dollar. That means it costs those people in those countries more of their own currency to buy anything that's priced in dollars, i.e. commodities, food, energy, all the things they might import. Okay, less of an impact on the countries that export commodities. But if you're a country like India, where you're importing commodities, importing your energy needs, this has been a real problem and has exacerbated the rise in inflation and knocked down the standard of living there. And in these cases, one of the things I warned about last year at the beginning of the year was if the Fed went too far and drove the dollar much higher, this could have a knock-on effect globally in terms of the economy. And that's exactly what's happened. And again, in places where inflation is higher, where food inflation is particularly strong, where the currencies have been wasted in terms of their purchasing power, you have a real problem going forward in terms of those economies. So it's against not just the U.S. And the Fed has by de facto become kind of the central bank to the world because everyone revolves around Fed policy because we are the consumer of last resort, that's for sure. The Fed is the borrower and lender of last resort. And in this case, when you have a U.S. dollar that is up by 20%, and I'm using the dollar index, which is a little faulty because it's a heavily European-weighted index, doesn't take into account emerging markets or Asia as much as it should. But by any measure, all right, using the dollar, the trade-weighted dollar, the emerging market basket, the CEW, which is an ETF that measures 20 emerging market currencies against the dollar, it really almost doesn't matter because by every measure, the dollar is up 20% or more on a year-over-year basis, or at least was at its peak recently. Every time the dollar's been up by 20% on a year-over-year basis, that's been turbulence in emerging markets. That's been enough turbulence in emerging markets to have an economic knock effect that actually affects the Fed decision-making process. And we're there too. So this all ties together to kind of say, where are we right now in terms of this process? And the bottom line is, as we come into Wednesday, I think there's a good chance that we will see the Fed take their foot off the brake a little bit. I think they have to. And what's interesting about this is, I could be wrong because the Fed has made several mistakes in this entire time. The Fed waited too long to start raising rates. We picked up on this and we made a lot of money being short the bond market because we knew the Fed was waiting too long when they were already waiting too long. Then when they first came with their first rate hike of 25 basis points, when other central banks were already moving 100 basis points, it was like, how lame is this? The market will have to do the Fed's dirty work for them. And that's exactly what happened. The bond market got crushed. It was one of the big trades of this year. And frankly, it was one of the easiest trades I can remember seeing in a long time, being short the U.S. bond market. So we made good coin on that. So now we're looking to take advantage of the flip side, that the Fed stays too long in their tightening, goes too far in their tightening, brings the economy down too much, lets too much. What they're trying to do is let some air out of the economy. They're going to let too much air out of the economy. Why? Because they're relying on the employment numbers to give us a key as to when to slow down. The employment number is the most lagging indicator of any economic data release that we have. The most lagging. And Fed Chairman Powell has already expressed concern that the amount of tightening they've done since July, it doesn't have an impact right away. There's a lag time there too. And that could be up to 12 to 18 months. So let's just say 65% of the Fed's rate hikes and the Fed's tightening of monetary conditions has come in the last 5 months, which means that that economic impact won't be felt until the second part of next year. Next year. The worst is yet to come economically. We haven't even barely seen the tip of the iceberg, even though I can tell you, I could rip apart Friday's employment number, and I did for our institutional clients, up and down. This number was not a good number, all right? Average hours fell. Average overtime fell, all right? You also had a decline, like I said, in the year-over-year rate of earnings, which is now, even deeper below the rate of inflation. So the fact of the matter is that the Fed will end rate hikes at some point. They're much closer to the end than they were in July, all right? And I think we might get some clue from Chairman Powell as to some light at the end of the tunnel. The question is, do they really want things to reflate basis and end to tightening here? And the answer to that may be no. It may be no. But the market kind of always leads the Fed. And in this case, the thing to note for me is the dollar is down significantly from its highs. More importantly, the gold adjusted value of the dollar, which is simply the dollar index divided by gold, all right, has come down significantly. And that was up 30% year over year, which was another thing. I mean, you're talking about when it's up $20 index on its own and it's up 30% against gold, that has always been a problem for the economy down the road. So we're in that vein. So what is the flip side idea here to try and make some money out of this to keep up? Because inflation will come down, but that doesn't mean it's going to zero, and that doesn't mean it's gone for good. It isn't. And the next time around, it's going to be a more difficult situation for the Fed. And thank God they've gotten 400, 450 basis points of tightening in, so they can use that to cut rates down the road when they're going to need it. And they're going to need it. So in that vein, what do we look for? Well, we look for things that might start to put in that have declined in the commodity sector that might benefit from a lower dollar down the road, because I think that's what's coming next. The gold adjusted value of the dollar is breaking down. Gold is actually breaking out on a short-term basis. And I particularly like silver because silver is breaking out against gold. Now you might say, what about Bitcoin? I, in some way, shape, or form, will ultimately be long Bitcoin. Would like Bitcoin, think there is value there. I don't think it's a currency. I don't think it hasn't been a hedge against inflation. It hasn't been a hedge against the lower stock market. But having said that, I kind of look at it like it's digital gold. I think in the age of polarization too, to think it has to be one or the other, you either have to love Bitcoin and hate gold or love gold and hate Bitcoin, is ridiculous. It's just stupid. I'm sorry. There's a place for both. Certainly in some way, shape, or form, it's going to be difficult for people in certain countries to go and just buy if their currency's coming off, take a place Some of the places where currencies have gotten really, really hit hard, like Hungary, for example. All right. You also have, the whole Russian-Ukraine situation right on the doorstep. You also have Hungary, imports a lot of their energy from Russia, is basically thumbing their nose at the EU. There's all kinds of things going on. The forint has gotten crushed, the Hungarian currency. All right. So maybe not so easy to go rush and buy gold in Hungary, but you got a phone, you can buy Bitcoin. So I think there's value there. But I think you need to own both, because say you want to go really doomsday prepper material here. You have a CME, or coronal mass ejection, which is basically a sunstorm that knocks out the electrical grid. Well, you're not going to get food for Bitcoin that's on an electrical grid that you can't access. All right, for a bar of silver, you might get food. I'm just saying there's value in both. You don't have to hate one to like the other. I like them both. But right now, Bitcoin is still in a downtrend. I will discuss Bitcoin in just a second on its own merits. But when I talk about really looking at this market, where is there a place to hide? Where is there some safety in terms of value? I like silver. All right. I'm not one of these guys that always likes gold and silver. I've been short gold and silver this year at times. So I am strategic either way. I don't get married to any one position, any one direction, any one theme. You have to be nimble. You have to be willing to admit you're wrong, and you have to be willing to change on a dime when it is warranted. In this case, I like the action in silver. It's kind of broken out on a long-term basis. It's above its 2-year moving average. You've had a really nice ABC, 61% Fibonacci retracement. I'll throw all these technical terms at you that you'll eventually come to know if you listen to our podcast over time. I mean, the setup in silver is pretty dang good. Not only that, but silver relative to the stock market, the S&P 500 specifically, the silver S&P 500 stock index ratio spread has broken out to the upside in favor of silver. Over the last 52 weeks, holding silver instead of the S&P 500 stocks has benefited you by 23% to the positive. That is big, and it's only beginning. If you look at the entire history of silver, of the S&P 500, and of the amount of money being printed by the Fed and where the dollar has been and is likely to go, I can tell you right here with no hesitation whatsoever, silver is dirt cheap compared to paper in terms of the U.S. stock market. Dirt cheap and worth buying. So how do you buy it? Well, that's a question, because we have so many different people listening and so many different ways that you might potentially buy it. So let's talk a little bit about the trading side, because I also want to be educational on trading, on risk management in particular. I've put out some of the social media posts about some quotes from some of the great books that I recommend everyone read. First of all, Market Wizards, both of them, number 1 and number 2. Must reads for everybody out there that wants to do this. All right. Number 2 is the Super Trader book by Van Tharp. All right. Van Tharp is the leading trading coach, the leading psychology of traders that I've ever known. This guy's been around forever. He has tutored some of the greatest traders of all time. I've been involved in seminars with him and some of his people. I mean, I'm talking about phenomenal insights into what makes a successful trader. And when Van Tharp breaks it down in his book, Super Trader, there are 3 things that it takes to be a great trader. And here's the percentage of those things necessary in terms of the 100% pie. Okay? You have strategy, you have psychology, and you have risk management. All right? Psychology, by far and away, number 1, 60% of the input is psychological. Risk management is 30%, which leaves only 10% for your methodology. Which means methodology is not as important as these other things, particularly psychology, and particularly having a risk management discipline that you have the psychology to be able to follow and to be able to stay disciplined. I can tell you from some of the experiments going way, way back too, you give a trading system that is proven profitable to 10 different people, you will get 10 different results, and not all of them will be profitable. Why? Because not all of them can follow the rules. They'll torpedo themselves. They'll self-destruct. There's going to be some psychological bent in there that's going to keep them from being their optimum selves, from making the optimum decisions. It's all about making the optimum decision at every moment, the EV, the expected value, kind of like being a high-stakes poker player. Sometimes folding is the strongest and only move towards survival. I could say that too. In terms of trading, I can give you a trader that's right only half the time who makes a ton of money. Why? His profits are 4 times his losses. 50-50 profit loss, 4 times the profit to the loss, guess what? You're going to make a ton of money. So a lot of this really matters. Risk management is huge. So let's take the case of silver here. Right now, silver's trading on the March futures contract, $21.36 an ounce. Where do you put a stop? Well, I am a very risk-averse trader in my money management for our clients, where it's $1 million minimum. And there's $1 million minimum because of things like this, what I'm about to tell you. All right, the stop in silver might be somewhere along the lines of, say, $22.45. All right, $22.15. Those would be 2 places I would have my stop based on the technicals that tell me when silver's trend is no longer bullish. It has nothing to do with how much money I'm willing to lose or risk. It has to do with what is the price at which I'm wrong, technically speaking. Well, if those are the prices where I'm wrong, I can tell you, let's use $22.45. Okay, against actually, the March contract is $23.41 currently, $23.41. So I'm using about $1 stop. It's 94 cents away. That's $4,800 on a standard futures contract. That's a lot. And if I want my risk management to be 0.5 or 1% per trade, which is what I want, then I need $1 million to trade 1 contract of silver. All right, not everyone has $1 million. Even at $100,000, it's very difficult. All right. So what are the other ways we can do it? We can trade the SLV. The SLV is the ETF that mimics the moves in silver. That is currently trading at 21.36, or it was when I wrote this down. Might be a little lower now. All right, you're looking at a stop there of around 1970. All right, that's $1.66 per share, because these are shares. It's a stock that you buy just like IBM or Amazon or Facebook or Meta or whatever. And it's the same thing, but it tracks the price of silver. The SLV, as in Victor. 21.36, we use 1970 as a stop. That's $1.66 away. If you have $100,000 to invest, all right, and you want to keep your risk to 0.5 or 1%, that means you can buy 300 shares, because you're risking 300 times $1.66, which equals $498. All right. So in that case, you're talking about, hey, can you risk more? Sure, you can risk more. The other way you might do it is to, instead of holding dollars in your account that you use as your trading stake, hold 15% silver, 20% silver instead of dollars. That might be another way. Or you use some combination therein to lever up if you want. You say, look, I'll hold 15% of my trading stake in silver, and then I'm going to go buy, 400, 300, 400 shares of SLV. I like silver here. That's the play. And in terms of Bitcoin, all right, we have traded Bitcoin for our money management. In all transparency, we bought Bitcoin at 4,600. I bought it again at 8,800 to amass a pretty good position. Sold the whole ball of wax at 54,000. Haven't been back in since. I think it can go to 12, and then I'll start to come interested again. All right, but in terms of the crypto world, and in terms of what's happened here, everyone's all surprised and everyone's crying, oh my God. It's funny because the whole thing around crypto, the whole thing around Bitcoin is it's not regulated, it's not controlled, there's no oversight, by any government, and that was the good thing. Now all the crypto people are wondering, why wasn't it regulated? This is the regulator's fault. I mean, come on, man, that's insane. That's so stupid it defies logic that people can even make that argument. The good thing is it's not regulated. Oh, we all get ripped off. Hey, why wasn't it regulated? I mean, well, what is this, man? I mean, is the Abbott Costello routine, for crying out loud? What I can tell you about the crypto world is this as it relates to Bitcoin. A recent study by MIT Sloan School and by the London Economics School of Economics, together, joint study, revealed that whereas Bitcoin is believed to be the most decentralized asset in the world, 2 things that were great about it: it's unregulated, no oversight, and it's decentralized. Well, now they want regulation, and now if you really look into what the shenanigans are around Bitcoin, I give it value. Trust me, I'm not bashing Bitcoin. There'd be times I will own Bitcoin. I think it is a good for what it is. It is a crypto. It's a digital commodity, is what it is. It's mined like gold. It provides certain kind of aspects of gold in terms of protection. It's kind of digital gold, if you ask me. It's a commodity, not a currency. It's never been a currency. But to say it's decentralized is simply not true. This study was fascinating. All right, it basically shows you that the bulk of Bitcoin are owned by the people that mined it and their pools, like the ant pool, which is like the #1 pool, and that most of the volume in Bitcoin is actually what they call peeling chains, which are pass-through orders. Basically, someone that owns Bitcoin passing it through multiple accounts that they themselves own to give the illusion of volume and to scatter this stuff so it's harder to trace. There's clusters, internal trading. In other words, trading between accounts owned by the same people is responsible for 80% of the transactions in Bitcoin. And yes, while individuals hold more, and while yes, kind of the pass-through orders and the peeling chains have gone down in terms of their influence on the market, it's still 80%. So keeping in mind, it's just like any other thing. You want to say gold is rigged and JP Morgan and some of these banks are involved? Sure. Look what happened on the LME with nickel. They shut the market down, killed the whole day of legal trading, and screwed people out of money. JP Morgan was at the front of that. Jamie Dimon came in and they rescued a Chinese billionaire who owns the largest nickel producer in the world. Why? Because without nickel, you don't have batteries for electronic vehicles. It's critical. And guess what? There's not enough nickel around. There's not enough cobalt. There's not enough lithium. This whole thing around getting EVs on the road to the degree they say they're going to is ridiculous. It's never going to happen. You need new battery technology, and maybe hydrogen, maybe fusion, maybe something else. You're not going to get there with electronic batteries, with electronic vehicles using the lithium batteries that require nickel sulfate, a lot in each. And there's just not enough nickel even above the ground to make up all these batteries. So that too is a fraud. Everywhere you look, you have to know what you're dealing with. All right, it's okay that Bitcoin's not the most decentralized asset like everyone says it is or wants it to be. It is what it is, and it's just like gold. You know, the bullion banks are involved. You know that someone's in there kind of manipulating gold and silver prices. I've known that for almost 4 decades. I've been doing this right from the very first introduction to trading gold on the trading floor. That it was manipulated, controlled by a few big players. It doesn't mean there aren't opportunities to take strategic advantage of some of these markets. And right now, as the dollar comes off and as the Fed heads towards what is ultimately going to be an end to this rate hike campaign, silver is looking increasingly attractive, and silver is dirt cheap relative to paper assets. That's it for today. Thanks for listening. Greg Weldon here with Money, Markets, and New Age Investing.